Moving on to learning objective 2, explain and apply underlying accounting concepts, assumptions, and principles. We have what is referred to as a professional framework. And when you think of the term framework, think of it in the context of a frame. Let's look at it like from a house or a building. There's a frame that's really what holds the building up. On top of the frame, you put in the walls, the interior and exterior walls. You put in all the electrical. You put in everything that you need for the home or the building. But the frame is what really sets the foundation of the building. I mean, it sets the entire building. It really is the basis of the building. Well, think of the personal framework or the accounting framework is the frame. It is what the basis is of how accounting principles are set. And we set up this framework by the use of what is referred to as generally accepted accounting principles, or GAAP, and often we use the reference to GAAP. And these aren't laws, they're really principle based. So I guess I would think of them more as guides, but they can be really specific as well. So you do want to make sure that you understand the principles and how specific they are to make a determination as to what you should and shouldn't do as it relates to preparing financial statements. That's what GAAP is all about. The principles associated with the preparation of financial statements. Generally accepted accounting principles are formulated by what is referred to as the Financial Accounting Standards Board, or FASB. This group is a private organization. It's made up of primarily CPA, certified public accountants. And the thought process is that CPAs in business, especially in specific industries, will be able to formulate the principles that would help to ensure that users get the best information necessary, ultimately, to make good decisions. Now, when we talk about GAAP, we talk about it in the context of the United States. The United States follows generally accepted accounting principles. There are standards that have been adopted internationally. We refer to those standards as International Financial Reporting Standards, or IFRS. This is more international. I guess you can think about it in terms of generally accepted accounting principles. That's like our laws. They're not really laws, but if you, just to kind of get through this, the generally accepted accounting is like our laws created by our Congress, as an example. International financial reporting standards are created by international guides. This would be equivalent to the United Nations when they prepare their laws, their rules. Even international financial reporting standards can be very specific. And IFRS has been adopted by a lot of different countries outside the United States. So if you ever work for an international company and have to prepare financial statements for those companies outside the United States, you might have to become familiar with IFRS, because if your company's stock is traded internationally on markets outside the United States, then there may be reporting requirements that you need to be familiar with. If you're a publicly traded organization and traded in the US markets, like the New York Stock Exchange, then you're going to be required to present information that's consistent with generally accepted accounting principles. Those are required by what is referred to as the Securities and Exchange Commission, which is the overseer of public entities. So our country requires generally accepted accounting principles. And by the way, there are some differences between generally accepted accounting principles and IFRS, and so you need to understand those differences if you're producing reports outside of the United States. Okay, focusing on our framework, when I say our, I mean the United States, we're using generally accepted accounting principles. And generally accepted accounting principles are really based on this conceptual foundation of accounting, this conceptual framework, okay? What is the objective? The objective of GAAP is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions and providing resources to the entity. When we first started talking about chapter 1, I explained to you that financial accounting is more about external parties. That's what we're trying to do, is provide information for external parties to make good decisions. Now, how do we follow that? Well, to be consistent with our objective, we're going to look at relevance and we're going to look at faithful representation. And when we look at these two terms, you should study them. You should look at your textbook and look at the definition and try to understand those terms in the context of accounting. When we're looking at relevance and faithful representation, we're talking about information that is important to the decision maker. And that's what we mean by relevant. If it's not important, why would you include it in there? So it has to be important to the decision maker. And then faithful representation means it's got to be something that people can rely upon, that we feel good that the numbers are reasonably accurate, that somebody is not cooking the books or making the numbers look better than what they're supposed to look like. They are very good representations of the organizations. Now, consistent with relevance and faithful representation, you have these terms that are supporting both relevance and faithful representation. What are they? Well, we're trying to, when we look at the term comparability or comparable comparability, we want information that's being presented by different companies that we can compare so that everybody's kind of following the same standards, the same principles, the same rules, so to speak, when they're creating these financial statements. You don't want to look at a financial statement for Target and then look at a financial statement for Walmart and later find out they weren't even following the same set of rules and they're really not comparable. That would be disappointing to you as an investor. So one of our objectives here is to make sure that we're producing information that is comparable, that everybody's following the same set of principles. The next thing we want is accountants like verifiability. If you say that your sales are $25 billion, can we verify it? That may mean that we have to go through and look at invoices. That may mean we have to look at receipts. We have to look at cash flows. Those are very important for accountants. We have to be able to create a system that is verifiable. The next term is timeliness. It makes no sense if you produce a financial statement 5 years after the fact. You have to be able to turn over these financial statements within a reasonable period of time. So if I'm trying to make a decision today, let's say, what are we in? We just started August of 2020. Then I want the most recent financial statements. At the latest, it at least has to be December 31st, 2019. Hopefully we have even additional information. And then it would also depend on when the fiscal year ends. But hopefully we have at least a fiscal year end or a calendar year end of December 31st, 2019 to be able to make a decision today. Now it is historical in nature, it is the past, but that will at least tell me what has been happening in the past, and experience will tell you that generally speaking, the past is the best predictor of the future. And the last word on the right side of this qualitative characteristics is understandability. We can't make it so complex that the average financial statement user really can't decipher anything. We just can't. We've got to find a way to make it so that The average financial statement user can look at it and make some very good judgments based upon that information. It's got to be understandable. We've talked about the objective, we've talked about the qualitative characteristics, then we've talked about enhancing qualitative characteristics, but then there are what we refer to as constraints. And constraints mean that there is some limitation to this. We can't just make it perfect. We're not looking for perfection we're not looking for perfection because it's way too expensive. So we have to look at everything that we do in the framework of cost. Does the benefit of the information that we acquire and we present exceed the cost of acquiring that information? The easiest example I can tell you is you're not going to spend $1 million security system to protect a $100 set of diamonds. That makes no sense at all. We're looking for a financial accounting system that helps to provide insurance to investors, but that insurance and protection can't be so expensive that it makes no sense. So that will be a constraint that we have to deal with all the time in accounting. How much does it cost us to do something? And we'll weigh that versus the benefit. From here, after looking at the qualitative characteristics and the constraints, we developed the financial reporting standards. GAAP has what we refer to as basic assumptions and principles. They are part of nearly everything associated with GAAP. When we call them basic principles or basic assumptions, they are really applicable across the board. And throughout this course, I'm often going to refer to why we do certain things and refer to some of these basic assumptions. The first assumption is entity assumption. And what this assumption states is that an organization stands apart from other organizations. In other words, it's its own separate entity, and individuals as a separate economic unit. Well, we talked about this already previously when we talked about a sole proprietor is a separate accounting entity. Well, this is really saying the same thing, that every organization is a separate entity, an accounting entity, and you must account for all of its transactions separately from the ownership. The next assumption is the going concern, or continuity assumption, the going concern. And that means the entity will continue to operate for the foreseeable future, which really gives us the basis for determining value. If a company buys something and they're going to go out of business in 6 months, then what they have may have very little value to that company. But when we're trying to look at whether or not something has value, that it's going to hold its value, we have to assume that that company is going to be a going concern, a business that will continue into the foreseeable future. The next principle is what we've already talked about a bit, historical cost principle. Financial accounting is all about the past. And in fact, when we're actually determining the value for many of our assets, they will be recorded or presented on the financial statement at their actual cost. Cost principle means we're going to value them at cost. Most assets for accounting purposes will be at their cost. Now, just so that you know, economists and financial advisors struggle with this because their thought process is, why would you do that? If something cost you $10,000 25 years ago, but now has a value of $100,000, you're telling me you're still going to keep it on the books at $10,000? And the answer is yes. If it's a certain type of asset, it will be at the original cost. And so that doesn't make a lot of sense to a lot of economists and to a lot of financial people. But the one thing the accountants like about the cost principle is that it's verifiable. If I want to convert an asset to its fair market value, how do I do that? Well, do I hire appraisers? Do I go out and look at, and furthermore, I bet you find me the right appraiser and I can find the right value that I want. So accountants refrain from that. Not in all cases, but in most cases they refrain from fair market values and go with the cost principle. And then the last assumption listed here on this slide is the stable monetary unit assumption, and that is that there's an assumption that the dollar, whatever monetary unit we're going to use, and we're going to be dealing with US dollars for the most part, but that there's a stable monetary currency that doesn't lose significant value over time, that it's pretty stable.